Welcome to the Deep Dive. We're TalkTickers, and today we're getting into the Q1 2025 earnings call for Jinhui Shipping and Transportation Limited.
That's right. We've gone through the call, pulled out the key details, what management's saying about the performance and, the outlook.
Let's hit those headline numbers for Q1 2025 first. They were, pretty eye-catching. Revenue was $39 million US.
Yep, $39 million. And their EBITDA, that's earnings before interest, tax, depreciation, and amortization, came in strong at $35 million US.
But here's the big one, I think. Net profit for the quarter hit $17 million US.
Which translates to basic earnings per share of 0.156.
And on the balance sheet side, gearing ratio looked, very comfortable at 16%.
Super low. Now, comparing Q1 to Q4 2024, these numbers really jump out. Revenue up 41% quarter over quarter.
41%, and that net profit figure.
It was up 6 times compared to the previous quarter. 6 times.
Wow.
Management also pointed out that the average time charter equivalent, the TCE for the fleet, was way up. They said 8.3 times higher quarter over quarter.
Okay, 8.3 times. That sounds huge.
It does. We'll dig into the specific TCE figures later, which tell a slightly different story per vessel type. But yeah, that was the initial highlight from them.
A 6-fold profit jump is definitely something. So, okay, let's unpack what's behind these numbers. What about costs? Shipping expenses went up, right?
They did. Reached $21.6 million in Q1. A decent chunk of that, about $4.5 million, was for paying more for chartered-in vessels, specifically short-term leases.
Okay, so bringing in extra ships temporarily costs more.
Exactly. And the higher costs were also linked to just having a bigger owned fleet. They grew to 26 of their own vessels by the end of March.
Right.
And the daily running costs for those owned ships, it did creep up a bit, from $4,830 a day last year, Q1 2024, to $5,375 a day this Q1.
Why the increase there?
Management said it was mostly initial costs, spare parts, consumables for the brand new ships they just got. They do expect that number to settle back down.
Okay, so expenses rose, partly fleet growth, partly charters, but clearly something else gave that profit a massive boost.
Yes, absolutely. This is really key to understanding that 6-fold increase. They had a small gain on financial assets, $1.6 million. But the real story, a settlement income.
Settlement?
Yeah, $20.22 million US. It came from some legal proceedings. Basically, a charter party didn't perform, and this payment settles that long-running issue.
Okay, so a big one-off cash injection.
Right.
That explains the huge profit jump this quarter. Makes sense.
Definitely a major factor.
All right, let's look at the balance sheet then as of March 31st. Total assets were sitting at $572.7 million US.
And total equity was $388.68 million US. On the debt side, $111 million in secured bank loans.
How's that structured?
$10 million is current, due within a year. The rest, $101 million, is non-current.
And the maturity profile, that sounded interesting.
Yeah, they highlighted this. Only 9% is due within 1 year, another 9% within 2 years. The vast majority, 82%, isn't due for 3 years or more. And they actually said they want to push that out even further if they can.
Seems manageable. What about liquidity?
Looks solid. Current ratio is 1.43 to 1. We mentioned the net gearing already, very low at 16%. And they had $48.6 million US in available liquidity.
Okay. And return on equity?
Boosted by that profit, it came in at 4.49% for the quarter.
And financing moves during Q1?
They drew down $15 million when that new vessel arrived.
Right.
And they paid back about $2.3 million on existing bank loans.
Got it. What about CapEx, spending on new assets?
$25.9 million US in Q1, mostly for that ship delivered in January, plus installments for other new ships they've got on order.
Right. Speaking of the fleet, let's talk about the ships themselves. They took delivery of one in January.
Yep, a 61,441 deadweight ton vessel. So end of March, they were running 26 owned ships and 8 chartered in. Total capacity about 2.5 million DWT.
But those numbers changed slightly by the time of the call in May.
They did. By May 31st, it was 25 owned and 7 chartered in.
What happened?
They sold an older ship, a Supermax built back in 2008, 56,952 DWT. Sold it for $10.2 million back in March. The ship was actually delivered to the buyer in May, though they expect the final bits of the transaction to wrap up in Q3.
So actively managing the fleet age, it sounds like?
Definitely. The average age of their own ships is 14.32 years. And yeah, the strategy is clearly about looking for chances to sell older ones and maybe buy newer ones, refreshing the tonnage.
And the chartered-in ships as of May.
7 in total then. 5 were on longer-term deals, 1 big Capesize, 2 Panamaxes, 2 Ultramaxes, and then 2 short-term Ultramaxes.
Okay, let's shift to cargo. What were they actually moving in Q1?
Minerals were the main thing, 52% of the mix.
And the rest?
Let's see, 9% steel products, 8% coal, 8% cement, 7% agricultural stuff, 6% fertilizers, and then 10% just listed as other.
And with the bigger fleet, they carried more cargo overall?
Yeah, quite a bit more. 3.31 million tons in Q1 this year compared to 2.61 million tons in Q1 last year.
Where was it coming from and going to in terms of revenue?
Okay, loading ports. Based on revenue, 35% from China, 20% Asia excluding China, 27% Africa, that's quite high, 10% South America, 5% North America, 3% Australia.
Interesting mix. And discharging, where did it end up?
Also a lot of China and Africa. Discharging ports by revenue, 38% China, 26% Africa, 25% Asia ex-China, 5% South America, and then 3% each for North America and Australia.
So China and Africa are major hubs for them, both loading and unloading.
Seems that way, yeah. Now, about those time charter equivalent rates, the TCEs. This is the average daily earnings per ship.
Right. Let's get into those details. How did the different ship types perform?
Okay, Q1 2025. Cape-size ships averaged $22,920 per day.
Which is actually down a bit from their full year 2024 average, wasn't it?
It was, yeah. Full year 2024 was over $24,000. Panamax vessels in Q1 earned $12,822 per day.
And how did that compare?
Also down. Lower than Q1 last year and lower than the full year 2024 average for Panamaxes.
And the Ultramax, Supermax ships, they're the core of the fleet, right?
They are. They came in at $12,192 per day. Again, a slight dip compared to Q1 2024 and the full year 2024 average.
So across the board, the daily rates were slightly softer than the 2024 averages.
Pretty much. The overall fleet average TCE for Q1 was $13,229 per day. Now, that is a little better than Q1 of last year, but still lagging behind the average for all of 2024.
Okay, so that earlier comment about average TC being up 8.3 times, that must have been calculated differently, maybe including specific contracts or something, because these TCE figures per vessel type show a softer trend compared to the full year 24.
Exactly. And seems like that headline figure might have been a specific calculation, maybe comparing just Q1 to Q4 or something unusual. The detailed TCEs give a more nuanced picture of slightly lower rates compared to the prior full year, even though they were up from Q1 24.
Right. So volumes up, revenue up, partly due to the fleet size and that settlement, but the underlying daily earnings power per ship type, well, maybe softened a touch from last year's peaks.
That seems like a fair summary. And that brings us neatly into the market outlook and what management was saying. They were pretty blunt. 2025 is full of uncertainty. And not just in shipping.
Geopolitics, obviously.
Yeah, the whole situation remains, fluid. And they specifically called out the new U.S. tariffs as a source of potential volatility.
How so?
Concerns about shipping costs, port charges out of the U.S., and interestingly, how Chinese-built ships might be treated down the line. They flag these as big question marks, things they can't really control.
Okay. Any bright spots?
Well, on the supply side, they think the number of new ships hitting the water should stay somewhat limited. Especially, they noted, if those potential U.S. actions dampen demand for ships built in China. They even mentioned seeing a drop in order books at one Chinese yard already in Q1.
Interesting angle. So given all this uncertainty, what's their game plan?
Prudence. That was the word. Keep the balance sheet strong. Keep looking for chances to modernize the fleet, sell older ships, maybe buy newer ones.
And operationally.
Try to maximize revenue, but also balance that with maybe locking in some longer-term contracts for earnings visibility.
Yeah.
But they stressed how hard that is right now.
Because of the volatility.
Exactly. They basically said it's almost impossible to give concrete forward plans. They need flexibility. They have to be ready to react to whatever the market throws at them.
Makes sense in this environment. Well, it came up in the Q&A. Did shareholders ask about that big settlement?
They did. Management said that $20 million is being set aside, for now, earmarked to potentially fund those fleet renewal opportunities they keep talking about.
And did they reinforce their focus on Ultramaxes?
Yep. Said that's their core expertise, the segment they see is the most defense. They operate other sizes too, just to kind of keep a feel for those markets, but Ultramax is home base.
What about returning some of that settlement cash to shareholders? Dividends, buybacks?
Someone asked. Management gave the standard line. Focuses on long-term financial performance, not short-term stock moves. But they did say they'd take the idea of using the settlement money for dividends or buybacks back to the board for discussion.
Any predictions on rates? Like, will Supermaxes stay around 12K a day?
Huh. No crystal ball offered there. Management just reiterated volatility is the name of the game in shipping right now. Can't predict rates.
And fleet changes. Any guidance on more sales or purchases soon?
Nope. Same theme. Impossible to commit. They have to react to market conditions, prices as they come. Said no new deals were signed at that point.
There's a bit about shipyards, right? Japanese versus Chinese.
Yeah, interesting point. Historically, Japanese yards were seen as better. But management's view now is that the good Chinese yards, they build dry bulk ships that are just as good for what Jinhui needs. These are workhorse vessels.
So quality is less of a differentiator than it used to be, maybe?
It seems that way, at least for this segment. They said the decision on holding on to specific ships comes down to quality, yes, but also customer needs, and that quality versus price calculation.
Any news on new long-term contracts being signed?
Not this quarter. Market's just too choppy, they said, to lock things in long-term right now. However, they did remind people that about half their fleet is already on long-term contracts, like 1 to 5 years signed in previous, less volatile periods. They mentioned that in the Q4 presentation, too. If they do sign new ones, they'll update the market.
Okay. And no guidance for Q2 profit or loss?
No, standard practice in uncertain times. Wait for the announcement.
It all comes back to flexibility and keeping cash ready, doesn't it?
Absolutely. They explicitly mentioned needing to keep their dry powder for those fleet renewal chances, linking it back to that settlement cash again.
Okay. So, as TalkTickers, we always have to say this. This deep dive is for informational purposes only. It is absolutely not financial advice. Investing in shipping, well, it's notoriously volatile and carries significant risk. Do your own research.
Couldn't agree more. However, just thinking about the themes management hit on, the volatility, the focus on Ultramax, the fleet renewal, those specific worries about U.S. actions in Chinese ships, you could spin up a purely hypothetical thought experiment.
Uh-oh, here comes the outrageous trade idea segment.
Well, highly speculative, right.
Yeah.
But it's just based purely on what they discussed. Imagine a pair trade within that Ultramax sector they like so much.
Okay, how would that work?
You could theoretically consider going short, betting against a basket of older, maybe Chinese-built Ultramaxes. Find companies heavily exposed there.
And the other side of the pair?
Go long companies or maybe indices exposed to newer non-Chinese-built Ultramaxes. You know, Japanese or Korean yards like they discussed.
So the idea isn't betting on the whole market going up or down.
Exactly. The speculative thesis would be that even if overall Ultramax rates bounce around, the gap in value between the older Chinese ships and the newer other build ships could widen. Maybe a quality premium grows, or a geopolitical risk discount hits the Chinese-built ones harder because of all the uncertainty management flagged.
So you're betting on relative performance within the sector, driven by those specific factors from the call.
Precisely. It's a way someone might try to play the specific nuances discussed, even without a clear view on overall market direction. But again, super speculative, purely derived from the call themes. Absolutely not financial advice, just food for thought.
Definitely food for thought. Okay, let's wrap up this deep dive on Jinhui Shipping's Q1 call, strong headline numbers, especially profit.
Yep, but significantly boosted by that one-off $20 million legal settlement.
And looking ahead, management sees a lot of uncertainty. Geopolitics, potential trade issues, tariff impacts, leading to volatile charter rates.
So their strategy is all about being prudent with the balance sheet, staying flexible, and looking for chances to renew the fleet, keeping that core focus on the Ultramax segment.
Despite the good Q1 results, the message was really caution and adaptability for the rest of 2025. Less about locking things in, more about being ready to react.
That sums it up well.
Remember, this deep dive was purely informational, not advice. Shipping is risky.
And here's a final thought to chew on based on this call. Management is banking on flexibility to navigate volatility, but they've also earmarked that big chunk of settlement cash for fleet renewal, which is a very long-term, capital-heavy investment that usually requires locking in commitments. So how sustainable is it to be purely reactive when you also need to make big, long-term capital decisions in that same volatile market? Something to think about.